We often get asked, should I use my HELOC to fund a policy? Well, stick around, because today what we're going to be talking about is the differences between a HELOC and IBC, and when you should use a HELOC.
And when you shouldn't. Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today what we're going to be talking about is the question that we get asked often is, should I be using my HELOC to fund a policy? First off, where does that question come from, right? Why are people asking that question? Number one is typically they're thinking outside of the box, so, right?
I like that.
Absolutely. I'm a big fan of it. But typically what they're doing is they're looking for ways to fund a policy or looking for ways to kind of increase their banking system. And if you guys know anything that's been happening in the real estate market over the last several years, almost everybody's got some equity, right? And so they see that, they're trying to tap into it, and they're saying, hey, how can I marry these two ideas? So let's dive into this. Anthony, how about we start with giving our listeners a little overview between a HELOC and infinite banking?
Okay, great. You know, there's a lot of similarities, right? They're both lines of credit, right? One is using a property as collateral, and then IBC is we're using your cash value as collateral. They're typically interest only, so the rates are typically variable, right? Now, what is also interesting, you know, the loan is independent from the asset.
What do you mean by that?
Is that with the equity of your...
I know what you mean by that, but maybe our listeners don't.
Well, so if the property goes up in value, or let me rephrase it, if the asset we're using as collateral goes up in value, that value is yours. It's not like the bank owns it.
Okay.
You know, but then also the reverse goes. If the asset goes down, that is on you. And also the outstanding loan is paid off when you sell the asset. So with the HELOC, if you sell the house, that HELOC gets paid off before you receive a dime. And also if there's an outstanding policy loan, the death benefit is going to pay that policy loan, and then the remaining amount will go to your heirs. Also, they can both have checkbook access, right? And maybe a lot of people listening to this may not have checkbook access to their policies, but we can do that if we add on what we call a life equity line of credit, or we call the HELOC, because it's very extremely similar to the HELOC.
Yeah.
Right. So we have a lot of content on there, and I think we have 1 or 2 podcasts explaining the pros and cons on that. So if you don't have a HELOC, I think there's a lot of advantages to it. So I'd check out that podcast to know why. But so there's a lot of similarities. There
are a lot of similarities. What are some of the differences?
You know, I think the differences are very important. And we were just going to talk about two of them. One is how you can get an increase in your line of credit. So with your HELOC, they take a snapshot of the value of your home when you get it, and you get a line of credit based on that value. Now, let's say the house appreciates, right? So there's more equity. If you want to increase your line of credit, you have to start from the scratch. You have to go back to the bank. We're going to need an appraisal and closing costs. We have to go through title. So the bottom line is, and you got to qualify, right? So which is an important thing, right? You have to financially qualify. And so you're paying additional fees. With IBC, all you have to do is make your premium, and your cash value is going to increase every year. And really, we can get a little technical. It'll increase even if you don't pay the premium. But the important thing is your policy value, or that equity, it's going to grow every year.
Yeah.
Right? With your premiums and also with interest and dividends. But to get access to that additional equity, You don't have to do anything. You don't have to requalify, right? And there are no fees. If you're using a policy loan, it's extremely straightforward.
Yeah.
Right? Now, if we're using a HELOC, we do need to get that line increased, but there's no fees to do so. All we in essence need to do is prove to them, hey, our cash value went up by X, and they will increase the amount. Okay. Another major difference is that you could get a decrease with the HELOC.
How does that happen?
Well, if you read the fine print, they can freeze your line of credit at their whim. Now, I don't know if you've had any experience with that.
I haven't had any experience of it with it personally, but I do got a story to share with you. Is that this is when we first got into banking. There's a pretty prominent attorney here in town in Las Vegas, and he had a great story of how he got introduced to banking and why he was doing it. But essentially, he had a line of credit that was called of no fault of his own, right? 2009-ish. Is he had a couple lines of credit that were out with his bank for business purposes, and he'd paid everything on time, no mispayments, none whatsoever. And they called him up one day, and they called the loan, and put him in a pretty tough spot. But it was that control piece that he realized he didn't have as much control over that as he thought. And that was the appeal to banking, and that is why he started to build some pretty large policies to fund his business opportunities moving forward. So another great little piece and a great experience from the past.
Well, and what I like about that story is that it talks about intangibles of using infinite banking.
Yeah.
A lot of times, and we're at fault as well, right? We're looking at the numbers, comparing IBC or paying cash, or what's the policy, what's the rate of return, and all that stuff, all that stuff that you can see, right? And we even did a podcast about the seen and unseen of infinite banking. This is an example of that unseen, that untangible, that you're probably not even thinking about it, because when you're getting that loan, things are good.
Yeah.
Right? You're not anticipating things to be sour. But, and again, what gets me, it's no fault of your own.
Yeah.
Right? It's one thing if I do a poor job or make a bad decision, I need to pay the consequence.
Yep.
But when other things are going around or other people make bad decisions and it affects me, no likey. Okay? So, what was it? I had a HELOC in 08. I had mine frozen, meaning that they wouldn't let me draw any additional amount out. But it wasn't called where I had to now pay them the balance. So them calling it is even worse.
Yeah.
Now, with IBC, they can't do that.
Why not?
It's part of the contract that you are able to, there is that loan provision. And what oftentimes I think people don't realize is the reason why the terms of these loans, when you get from, like when you use IBC, they're not running your credit. They're not asking for what it's for or what the repayment schedule is. It's in essence, how much do you want and where do we send it to?
Yeah.
And the reason being is because we're borrowing the insurance company's money and they're using your policy as collateral. Thus, the bank's going to get paid back. I mean, they're literally waiting until you die and repay the loan.
Yeah.
So the risk for the insurance company is minimal as you can get, right? But the risk for the bank is much greater. So that's why the loan provision isn't dependent on your credit or your income. It's dependent on the equity inside the policy.
That's interesting, right? Is what we're talking about is borrowing against an asset, and right, what we're introducing people to is the idea of borrowing against cash value in a policy. But people are typically more familiar with borrowing against a HELOC, and if you kind of introduce it to them that way, they have a pretty good understanding. But I don't know if somebody's read if you guys read the article from ProPublica. You and I have had this conversation. This is what wealthy people do, right? And wealthy is a pretty broad term, but somebody that's a business owner and their business is very successful, they need or want to keep the capital in that business, and so they'll create or draw a line of credit against that business and the revenue and the income and the assets that they have. That is not foreign to most kind of successful business owners or wealthy people. And so really what we're introducing is just another opportunity to collateralize an asset that someone has and borrow against it. So,
all right. So Cameron, why don't we answer this question that everybody's on pins and needles, right, on this podcast? Should somebody use a HELOC as part of their infinite banking program?
Great question. The answer is we could, but I wouldn't start there. I would say that most of the people that are asking this question is somebody that's pretty new to infinite banking, right? We get a lot of people that reach out to us on a weekly basis and are saying, hey, how can I get started? How can I get this going? And usually it's in that conversation that it comes up. And I'm going to tell somebody that's brand new to the infinite banking, do not use a HELOC to get started with infinite banking. What you want to start with is what you're able to save on a monthly or annual basis. And we've got lots of time to kind of increase premiums or do anything there. Really what we're trying to do the first year, year and a half, maybe 2 years is really just get down the process of infinite banking, right? We're going to be storing our cash somewhere a little bit different than most. We need to understand some of the loan provisions. So there's a little bit of a learning curve. And so let's make some of those lessons that we're going to learn along the way on something that's manageable and easy. And then I would say down the road, right, if we feel comfortable and we've got some opportunity and we understand exactly how this thing's going to work out, then maybe we can consider using a HELOC. But we certainly don't want to start there. Anthony, what's your 2 cents here?
Well, totally agree with at the beginning. Let's get this. I mean, oftentimes we do have to talk people down from premiums, right? They read the book or listen to the podcast, and this is great and just want to jump head first. I appreciate it, right? But we want to make sure that this is the right fit for you. So I'm totally with you at the beginning. But for somebody who has some experience with IBC and maybe some financial education as well, I think that that there is a place of using the HELOC. And
when would that be?
What I would say, like some examples that I would use is that if we want to start a policy before maybe we need to. For example, maybe we have a future windfall that we are expecting in a year or two. Maybe that's a business sale of an asset or inheritance or whatever it is. If they're confident that we're going to receive some cash flow in the future, when's the best time to create a space for it? Be better to do it now. So the one strategy can be is using that that line of credit to fund that policy. But what I think is important, you need to have a plan to repay the loan, whether it's a policy loan or the HELOC. And so in this case, our intention is on this future windfall.
Yep.
And I think that this is similar to the math that we did in the podcast on running your taxes through a policy. Very similar process, but what we were doing there is we're getting the money for the policy from our estimated tax payments. We were running that through the policy. Here, we could run that line of credit through the policy. So I guess my first thing would be is if you have a plan to repay that loan. Also, I think the downfall of the HELOC is, again, we're using a short-term loan for a long-term asset, which Robert Kiyosaki talked about in the cash flow quadrant, not to do. But you may have a loan, like here's another way that I would look at it. If we want to get that equity of the home out of the house and kind of into cash where we can actually use it and deploy it. HELOC is one way to do it. Another way is actually doing a cash out refi. Now, about 6 months ago, that was a no-brainer.
Yeah.
Right? When the interest rates are so low.
What are we, September 30th today? Yeah.
Yeah.
Different.
But now the loan rates are around 7, so maybe now is not a good time to do that.
Mm-hmm.
But I would say I got a 30-year fixed loan at 3.25, I think 3.75, and this wasn't a mortgage, but that interest is tax deductible. So I had that windfall, and I wanted to use that money to invest. But in the meantime, where am I going to put it?
Mm-hmm.
So I put it into the policy. I would say I also ran the math and say, hey, what if I don't do any investing? Will I be able to repay that loan? But here we have a long-term loan with a long-term asset.
Mm-hmm. Awesome, guys. Stick around. Come back and join us. Right, we are doing some live streams later on. I think our next one is going to be Thursday, October 30th. So join us every third Thursday of each month moving forward. If you guys have questions such as these, go ahead and bring them. We'll be interactive. We'll answer them live with you guys, and then anything related to IBC, obviously.
Great. Now, I still want to talk a little bit about the HELOCs.
Okay.
Right.
Go for it.
We're big fans of HELOCs.
Yeah.
Right. And the time to get the HELOC is now. If you don't have one, because one thing you heard us talk about, banks will only loan you money when you don't need it.
Mm-hmm.
It's like your neighbor who will loan you an umbrella when it's raining. I'm sorry, I just threw that. They're loan you an umbrella when it's sunny out.
That's what I would do with you.
Right?
Yeah. And
Of course you
would.
would.
Take it back when it starts raining.
Well, you'd want it because you don't want to mess up your hair if it's raining. But
I don't go outside when it rains.
Once it starts raining, the bank is like, hey, I need that umbrella back. And you're like, well, it's raining.
Mm-hmm.
I know. That's why I need it back. Mm-hmm. Right? But so it's very similar to banks. They're loan you money when you don't need it. But when you do need it, they're not going to loan it to you. So one strategy we would recommend you evaluate is getting these lines of credit, whether it's a HELOC against your home or maybe there's a business line of credit. We want to get access to liquidity. I mean, so we are officially in a recession.
Believe it or not.
I honestly think there's a possibility for it to get a lot worse in the economy. But so what that means is we're going to need liquidity, either maybe to kind of help us pay our bills or to run the business. But also there's going to be a lot of opportunities here because a lot of people are not going to be ready for this recession, and which means there's going to be assets on sale. If the banks tighten up like they did in 2008, we're not going to be able to get the money from them. But if we have that cash, we now have the ability to jump on those opportunities. Now, the problem is, like we talked about, the ability of the bank to freeze the lines of credit. So what I would recommend, and this is what I'm going to do, is when the economy starts going sideways, I'm going to take the HELOC out and my lines of credit. I got to store it somewhere. And to be honest, if things are going sideways, the last place I want to put it is going to be in a bank, to be honest. But what if there was a place, Cameron, where I could put this money that it would be liquid so I needed it, but it'd also be safe so I know the money wouldn't go down. And if there's some asset protection, that might be a little bonus.
Yeah.
You feel me?
If only we knew a spot.
Yeah. But Cameron, I got a spot for you,
yeah.
right? That's one of the many reasons what our policies are for. And where I've talked about, I don't pay off all my loans entirely. I always want to keep a gap for cases like this. So when this goes sideways, I'm going to pull that money out and I'm going to store it inside my policy, and maybe I might just have it sit there, right? I will be paying interest on that loan, but also remember I just paid off a policy loan, so I'm saving interest as well. But the important thing is, even if it is costing me money each month, the ability to have that liquidity, for one, is going to help me sleep at night.
Mm-hmm.
But also, I'm hoping that in 3 years, my family is going to be much better off financially than they are now. But in order to do that, we got to start making some. We have to start getting ready now, because that winter's coming.
Yep. Awesome. Great overview. Great explanation. All right, guys. We hope that this helped answer the question of should you be using a HELOC to fund a policy, and I think the takeaway was maybe.
Don't you love that?
Exactly. I think we should draw it, open it up, and then we'll see what happens here over the next 6 months, 12 months or so. But, guys, make sure you join us for those live streams, and I hope you enjoyed this episode.
Make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.